The financial world is as fickle a place as they come. There really isn't any guarantee of what will happen next. Rewind to a time when you thought predicting what would happen in the stock market was a risky thing to do. Fast forward to the world of crypto, which is the volatility of the stock market on steroids. In today's video, we'll be talking about the latest sinking ship of the crypto world, FTX.
Business with any chain of people who did business with one of the troubled assets themselves became trouble.
First things first, Tom Brady's crypto exchange in hot water with customer funds. Different reports of just how messy the situation is over at FTX have been coming out for a while now. However, the exact details and the severity of the crisis were still unknown to the public for the large part. But now that the situation is out of control, disturbing details of that, are slowly starting to come out from inside the crypto exchange, which was valued at a whopping $32.5 billion earlier this year. Rumors had already started coming out that the popular crypto exchange was having some serious liquidity issues. Things finally reached a breaking point when the exchange was hit with withdrawal requests of around $5 billion on Sunday. There's no way in hell that the exchange would ever have been able to fulfill those requests in this situation. If there wasn't enough trouble over at FTX already, it's now being alleged that they gave an insane amount of money to a sister company, which in turn used that money to fund risky bets. All the funds being handed out to the sister company are believed to be the customer's money. FTX's founder, Sam Bankman-Fried, initially denied the claims when he tweeted that FTX has enough to cover all client holdings. The founder also denied using any of the client's funds for investments. However, Sam later deleted that tweet. Up next, FTX files for Chapter 11 bankruptcy. FTX was the world's third largest cryptocurrency exchange, but those days seem like a distant memory now after their continuous liquidity problems and the meltdown of last week. It has been announced that they have filed for Chapter 11 bankruptcy in the United States. It looks like FTX's desperate attempts to keep the company's head above water have failed. The company made multiple desperate attempts to bring in some funding by looking for some sort of acquisition. They also looked at the possibility of generating new funds from the market players. However, it looks like none of their attempts have been fruitful. Founder and CEO of the company, Sam Bankman-Fried, has also resigned from his role with the company after they filed for bankruptcy. Veteran restructuring lawyer John J. Ray III, who famously worked on the dissolution of Enron, is going to be the new CEO of FTX. In addition, bankruptcy procedures have also started for over 100 other companies that were affiliated with FTX. These affiliated companies include names like Alameda Research and FTX US. The company issued a statement in which it mentioned that some of its subsidiaries, including FTX Australia, FTX Express Pay, LedgerX, and FTX Digital Market, will not be a part of the bankruptcy process. The new CEO, John Ray, said that filing for Chapter 11 was the best thing to do in this situation, as it will allow us to properly assess the severity of the situation. He said that the main focus of the proceedings would be to try and maximize the recovery of assets for all the stakeholders. Moving on, failed takeover attempt by Binance. Once their liquidity problems were out in the open, it was clear that FTX was out in the market for a big player to acquire them and help solve the shortage of funds. And it looked like they managed to convince Binance, which is the largest cryptocurrency exchange in the world. It was announced on Tuesday that Binance had signed a letter of intent to acquire FTX. However, that didn't materialize either, as just 24 hours later, the cryptocurrency giant backed out from the deal after assessing the situation at FTX. It was quite clear that Binance was backing out of the deal because of the investigation around the mishandling of customers' funds. There wasn't any other explanation for it, as there's practically no money problem that a giant like Binance can't handle, to be fair. Binance didn't leave much room for speculation as they announced the reasons for stepping away from the deal. In their statement, Binance said that they were hoping to step in and provide the required liquidity in order to bail out FTX's customers. But the severity of the crisis at FTX was beyond anything they could have helped with. In a tweet, Binance shared that because of the findings of their corporate due diligence and the investigations by authorities around the mishandling of customers' funds, they have decided not to move forward with the acquisition. Next up, what exactly was the misuse of customers' funds? According to the Wall Street Journal, the main party involved in this scenario is a firm called Alameda Research. Alameda is another trading firm that was also founded by FTX founder Sam Bankman. According to the reports, Bankman told the investors that Alameda Research was in FTX's debt, owing around $10 billion to the company. To explain it lightly, Alameda specialized in making risky trading strategies. Many blockchain experts have criticized the strategies used by Alameda Research, citing that the reward is too low for the amount of risk involved with the strategies. It really is an insane situation, because when you think of the numbers involved, nothing makes sense. FTX held about $16 billion in customer funds, and it lent Alameda $10 billion, which is more than half of the customer assets they held. As per reports, FTX was facing a shortage of around $8 billion. Something really is up with the way these funds were being handled, because one would count on an experienced entrepreneur like Bankman to make better financial decisions. Bankman himself called the decision to lend money to Alameda a poor judgment call, which to us is laughable at the least. Continuing on, the wipeout of the Brady's assets. It looks like things are not going too well for one of America's favorite athletes. The 7-time Super Bowl champion, Tom Brady, was one of FTX's biggest advocates, along with Gisele Bündchen, who was his wife at the time. Brady announced in mid-2021 that they had acquired an equity stake in FTX. Brady defended his decision at that time, mentioning that it was an exciting time in the world of crypto with endless possibilities. He particularly expressed his faith in the CEO of FTX, Sam Bankman. Brady further said that he looked at this as an opportunity to increase awareness around cryptocurrency and its promise, and a chance to give back to the community and the planet. The NFL superstar also took on the role of a brand ambassador for FTX, with his wife Gisele also joining the company in another capacity. However, before problems started to surface in the world of FTX, problems already went beyond the possibility of repair in the world of the Bradys. The glamorous couple had an estimated net worth of $650 million combined before their divorce last month. At this point, we don't have a clear idea of how much of their net worth was tied up with FTX, but whatever the amount was, they looked set to lose out on most of it, along with the other investors in FTX. Well, Tom, we genuinely hope that things get better for you. Finally, it was actually FTT that triggered the downfall of FTX. There were increasing concerns around reports that Alameda, the company where most of FTX's funds were parked, the balance sheet was too dependent on non-liquid tokens, including FTT, which is FTX's own token. As a response, the CEO of Binance, Changpeng Zhao, announced that he was going to sell off his holdings in FTT. At the time of the announcement, his holdings in FTT were worth $584 million. Zhao's decision to sell his holdings in FTT sent the token into almost a total collapse, bringing back memories of the Luna Terra disaster. Matt Levine, who is a columnist at Bloomberg, labeled FTX's decision to hold FTT as collateral being caught in a death spiral. He said that the decision was completely insane, as you can't keep something like FTT, which was basically a stock of their own company, as collateral. He said that if an investment bank's financial health comes under concern, the price of its stock will also go down. If the price of the stock goes down, the value of the collateral will also suffer. If the price of the collateral suffers, the financial health of the bank will get worse, and this trend will keep spiraling downwards. He said that if the bank keeps its own stock as one of their main assets, then it's quite easy to bankrupt them. You just have to short the bank's own stock. And that's where we'll end our video today. Thank you so much for being with us. We would love to hear from you. What's next for FTX and Sam Bankman-Fried? Does the future hold more uncertainty for the crypto markets? Don't forget to let us know in the comments section. Please make sure to hit that like button and subscribe to our channel for all the latest news in town. We'll see you in the next video.